Again, my name is Marlon Glenn. I am with the KCT Credit Union. And as Sadia said, I'm the financial wellness educator there, which really means I'm not here to sell you anything. My position with the credit union is really just strictly education. That is the sole purpose of my position. So to try to get you as much financial information, resources, tools as I possibly can to kind of put you in a better financial situation, hopefully, than what you're in currently today. So today's session, I hope to give you some insight, maybe some tools, resources to either get you out of debt or to get you to better manage your debt and credit, whether good or bad. So we'll talk a little bit about what the difference is between good credit and bad credit, what kind of debt is out there, and whether you have good debt or bad debt. So to kind of give you an idea of that. So let's go ahead and get started. And the very first thing we'll talk about is what is debt? So there's a nice little definition here on my screen, but basically the answer to that question in layman's terms is it's money that you borrow, right, with an understanding or an agreement, maybe a contract that you will repay those funds. Okay, so not all debt is bad. Again, there could be good debt, and what's considered good debt can be money that you're putting towards an investment of some sort, or something that might appreciate in value, such as a house, right? Possibly maybe a student loan or a small business loan. This can enhance your career, maybe not at the moment, but it will at some point hopefully enhance your career and your life. So, but in layman's terms, again, debt is really just money that you have borrowed, money that you owe with an understanding that you're going to pay that money back. And then we'll ask ourselves, what is credit? So typically, debt translates into credit. It is the fact that someone allowed you to borrow that money and that now you owe that money, and they've extended credit to you. I do like to remind everybody, as you can see on the screen, credit is a privilege. It is not a right. So nobody has to extend credit to you, as long as they're not discriminating. But nobody has to extend credit. It is definitely a privilege. So I like reminding people of that because a lot of people think, well, I'm just going to go and apply for a credit card and they're going to give me a credit card. However, that creditor does have the right to not extend credit to you. Again, in order to obtain good credit or improve a credit score, you need to know how to handle debt. So they go hand in hand. And there are different types of debt. So let's break them down a little bit because they can translate differently onto your credit report. So there's secure credit, and this utilizes some form of collateral. So this means you've got something that typically a bank can take away from you. So this is your mortgage because they can take away your home, right? Or your car note or car loan. They can take away your car. They can repossess your vehicle. Those are all forms of secured credit. Unsecured credit has no collateral attached to it. These are typically your credit cards or unsecured personal loans. Okay, and then we have the difference between fixed interest rates and variable interest rates. So a fixed interest rate just means that this is going to stay the same for the entire timeline of that loan. So most of us have a fixed interest rate on our mortgage if we have a mortgage. Most of us have a fixed interest rate on our car if that's the case as well. A variable interest rate is going to possibly change over the life of that loan or the term of that loan. So a variable interest rate is, again, very much like something on your credit card. That credit card may be at a 14, 15, 16% interest rate. And that can change over time. All that needs to happen is they need to notify you that that interest rate is changing. They give you, I believe, typically it's a 30-day notice, and then that interest rate can also change as well. Then you have installment credit, and this again means that there's a certain term to that loan, and once that term is gone, so let's say 60 months, so 5 years, after that 60-month period, then that loan is going to be paid off. There's nothing going to be left to it. You've just paid it over that 60 months in equal installments typically. Sometimes that last installment can be a little bit different. But once you've made those 60 payments, that's it. You're done. The loan is gone. It's paid off. And then there's revolving credit, which again can be your credit cards. This can be paid at any time. So typically with revolving credit, you have a monthly payment that's due. If you make that monthly payment, that's not to say that you have paid the whole balance off. So if you owe $1,000 on your credit card bill and your monthly payment that you receive is only, let's say, $100 for the month, and you only pay that $100 for the month, then you're still going to owe $900 or plus after you've made that payment. Revolving credit just means that you may have some additional credit available to you. So you may have a credit limit on that credit card of $5,000. You only owe $1,000, but your monthly payment might only be $100. So you're still going to carry a balance on that credit card. Okay. So those are the different types of credit kind of broken down. And then if we break these down even further, as we just saw in the previous slide, some of the main sources that lead to credit are your mortgage, your car loan, your credit card, and your student loans. So some questions that you might be asking yourself: what are the benefits of all of this debt on my credit report? Is taking on credit or debt ever a good idea? Well, again, there is such a thing as good credit versus bad credit. I alluded to it at the beginning and said, if you have good credit in general, this is going to increase your net worth. You're putting yourself into debt for something that's going to typically appreciate in value in some way, shape, or form. So again, good debt can be something like a mortgage. Typically, we will assume that your house is going to appreciate in value. And as you're paying down that mortgage balance and your home appreciates, that means that you're putting yourself in a better position. Investments. So you can borrow money to increase for future investments. So interest rates are an all-time low still now. There's some people that are of the thought that, well, maybe if I pull some money out of my mortgage, maybe if I refinance and I pull out, let's say, $10,000, because I'm only going to pay a 3% interest rate on my mortgage for the next 15 years. And I'm going to take that $10,000 and I'm going to invest it. And over the next 15 years, I'm actually going to yield an interest rate of maybe 5 or 6% on average. So that can be looked as having some good debt. Maybe you do a home equity loan of some sort instead of refinancing your mortgage. The point is that because interest rates are so low on mortgages right now, it may be something to think about to pull some money, to borrow some money at a very, very low interest rate to hopefully gain or yield yourself some additional money as far as interest goes. So that can be looked at as good debt versus bad debt. Bad debt is something that's not going to increase your wealth in any way, shape, or form, or is used to purchase any lasting value services or goods. So this is typically the purchases that we're going to make on our credit card, right? So that $50 pair of jeans that are fabulous are not likely going to help you in any way, shape, or form financially. What happens is unless you pay off that $50 pair of jeans, so unless you pay off your credit card on a monthly basis, which is the wisest way to use credit cards, to use them and then pay off that balance so that you're not paying interest on them, that really is considered bad debt. You've really gained nothing. Yes, you have an additional pair of jeans. Do we need an additional pair of jeans? Then you have a whole slew of questions that you could really kind of ask yourself by making that purchase. And if you didn't pay it off as soon as that bill came in, well, more than likely you're paying upwards of 10 or 15% interest on that credit card. So that is considered bad debt. And what are the costs of that bad debt? So I kind of alluded to it in the previous slide, but it can be very costly. So in this example that you can see here, if you had $20,000 of credit card debt and it was all, let's say, at 18%, and you're making the minimum payment of 2%. Minimum payment of 2% on $20,000 is $400 a month. It can take you 20 years to pay that off if you're making just that minimum payment every month. So I'm sure that most of you, if you have credit cards and you've received your credit card statements and you've actually looked at them, in the last couple of years, a new rule, and don't ask me the name of it, but I know that there was a new rule, a new law that was put in place where your creditor, your credit card statement has to show you the length of time that it will take you to pay off that credit card balance at the interest rate that you're currently at. So a 18% credit card rate is not outrageous these days. In 2019, the average interest rate on an existing credit card was about 14%, just over 14%, and about 19% for new offers, for new credit cards. So 18% is really not out of the normal realm of a credit card interest rate. So if you are carrying balances on those credit cards, it can take you quite a long time if you're only making those minimum payments. So in this particular example, it's going to take you 20 years to pay off that $20,000. It will have cost you $54,000, over $54,000 to borrow that $20,000. So, and this is all on credit cards, which again, typically most of us are putting, maybe our shopping sprees on credit cards, possibly our vacations on credit cards, things that are not normally necessary. They're not necessities. They're not, necessary for you to continue to exist. So most of us are putting on our credit cards kind of those splurgy personal type of items. So if you pay $74,078 for something that originally only cost you $20,000, in this example, you're paying over 270% interest in the long run over that 20 years. You heard that right, 270% interest. So it's kind of crazy if it takes you this 20 years. Is it going to take you 20 years to pay off $20,000 worth of credit card debt? It may, if you continue to only make the minimum payments. So that's a little bit of an exaggeration, a little bit of a large scale example. This example here is a little bit smaller scale. So this is an example of if you borrow $1,000. If you borrow $1,000 on a credit card with an interest rate of 10% versus 15% versus 25%. And if your monthly payment is the same on all of those, $40 a month, at 10%, it's going to take you about 29 months to pay that off. You'll have paid $1,126. At 25%, it'll take you 36 months and you'll have paid a total of $1,427. So just so that you can see the difference, there is about $300 between a 10% interest rate or a 25% interest rate. So, and one of the reasons that I like showing that example is because the interest rate on your credit cards, the interest rate on basically all of your loans, all of your debt, is very dependent on credit, on what your credit looks like. And we'll talk a little bit about that here in a little bit. But debt can be very, very beneficial, very helpful to temporarily expanding your income. So it is important that you ask yourself, can I really afford it? It goes above simply making the monthly payment. You need to really consider all of the factors. For example, the opportunity cost. What will I be giving up to make this particular purchase? And will adding this debt keep me from other financial obligations like paying myself first, right? Putting money into my savings account. Um, that's something very important to consider. Or understanding the difference between needs and wants is very critical when you're considering taking on additional debt, or creating debt. For a want can be very dangerous for your financial stability, right? Do you really need that $50 pair of jeans, or do you just want that $50 pair of jeans? And if you purchase that $50 pair of jeans, can you make that $50 payment when the bill comes in? If not, the question is how many $50 pair of jeans are you going to purchase for the month? And do $50 pair of jeans turn into $100 pair of jeans, which translate into a $150 outfit? So definitely some questions to ask yourself. Is this really a need, or is it more of a want? And if it's a want, can I actually pay it off, or can I afford to take on this additional debt for it? So debt can turn into quicksand very, very quickly. It can make you feel like you're never going to get away from it, and it certainly can cost you. So some of the warnings about having too much debt on my screen here, if you're putting day-to-day bills on your credit cards, you might have too much debt. If your credit cards are all maxed out, you might have too much debt. If you're skipping other payments, if okay, well, I'm not going to pay the electric bill because they're not going to shut off my electric yet. I'll just pay it when my next paycheck comes in. If you're simply just making the minimum payments on your credit card, you may have too much debt. So be very careful not to have too much debt, and asking yourself some of those questions. Is this really a need, or is it more of a want? And if this is just a want, can I really afford to pay this off when the bill actually comes? So those are questions that you should really be asking yourself every time that you reach for that credit card. So if any of these signs, any of these warnings, hit close to home, you should be taking steps to work through the situation, whether that's going for a debt checkup. I'm sure many financial institutions offer that, or setting up some sort of SMART goals on your own to pay off debt. But the longer you wait, it's going to be harder to pay off that debt. So the sooner the better. The worst thing that you can do is nothing at all. So figuring out whether your financial institution offers some sort of debt checkup is the best way to do it. But I mentioned setting up some SMART goals. Here's what that means. SMART goals are specific, they're realistic, they're adjustable, and they're measurable. I kind of went out of turn there. And they're time oriented. So what does that mean? If I simply say I need to pay off my credit card debt, I'm much less likely to do that, right? If I just say I need to pay off my credit card debt, what does that mean? That's not a very specific goal. It's not time oriented at all, and it's nothing that's really measurable. But if I say I need to pay off $1,200 worth of credit card debt, and I need to do that within the next 12 months, and the way that I'm going to do that is I'm going to brown bag my lunch to work every day, or the days that I don't, I'm not going to stop for coffee. I'm not going to stop at Starbucks or Dunkin' Donuts, or whatever my coffee stop is. So that would be a very specific goal. It's specific, right? I need to pay off $1,200 worth of credit card debt. It's measurable. I want to do the $1,200, and I want to do that within 12 months. It's adjustable. I'm going to do it by either brown bagging my lunch or by not stopping for my coffee every day. It's realistic. It's $1,200. And we'll go back to that. And it's time oriented. I want to do $1,200 within 12 months. You might be saying to yourself, it's not realistic because it's $1,200 and $1,200 is a lot of money. However, when you set your SMART goals, the key to setting your SMART goals is also to break those down. So $1,200 translates to roughly about $100 a month, right? Excuse me. $100 a month translates to about $23 a week, which translates daily to about $3.29 roughly. So $3.29 a day. That's less than the price of a cup of coffee if you're stopping at Starbucks, possibly around the price of a cup of coffee at Dunkin' Donuts. It's certainly less than lunch if you're going out to lunch every day. So $3.29 seems a lot more doable for most of us, right? Um, so that's $1,200 for the year. So the trick is to kind of break those goals down on a daily. And if you wanted to go even further, it's $3.29 for the day. How many hours do I have to work to be able to obtain that? Maybe I work the extra 15 minutes at work if I'm able to, if I have the option for overtime or whatever the case might be. But really kind of breaking those goals down can help in a big way. So, more specific signs about whether you have too much debt. If you don't have an emergency fund at the bottom there, no emergency fund. You should have 3 to 6 months of your total income in an emergency fund. And that emergency fund should be for specifically emergencies. So my car breaks down and I need $2,000 to get that back up and running. Or I've had a medical emergency and now I owe, I have this $1,200 bill that I need to pay. That is what your emergency fund should be for, so that you don't incur any additional debt. Because debt can be very overwhelming and it can become a very vicious circle. And that's really kind of what happens as you see this image here. If you're living paycheck to paycheck, your debt to income ratio is very, very high, meaning you carry too much debt for the gross income that you make. Your credit card balances, if they exceed more than 10% of your income, you've got a lot of debt. If you don't have an emergency fund, if you have no money set aside for retirement, so if you have not started a 401k or an IRA of any sort, this is a very vicious circle that you can fall into here. So these are some more serious signs that you might have too much debt. So how can you tackle some of that debt? Well, here's some very good options for you. So you do need to make a game plan. You need to set yourself some SMART goals. You need to sit down and understand what you actually owe. So what are the balances on my credit cards? What are my monthly payments on my credit cards? You need to get yourself very organized. You need to eliminate what you can. So as you get yourself organized and as you figure out how much is my income, and what is the monthly payments on all the debt that I owe, and can I eliminate those in any way, shape, or form? Definitely, I would seek out some assistance. I alluded to the debt management. So, as a credit union, we're a nonprofit, and we do offer all of our members for a representative to sit down and go over the debt that they currently have to see if there's any options for possible consolidation, refinances, whatever the case might be. Lowering those interest rates is certainly a way that you're going to be able to get ahead if you possibly can. Cut out spending. So really finding those spending leaks and knowing, where all of that money that kind of just disappears. That's kind of the eating out, the having cash in your pocket, so kind of cutting that out and making yourself an actual spending plan. Increasing your income obviously is a way to get out of debt, whether that's obtaining a part-time job, whether that's selling, merchandise on, marketplace or eBay or whatever the case might be. Selling whatever it is that you don't need or don't use anymore, and making a free list. This is one of my favorite things. Finding all the free events that you possibly can. So the libraries, I love librarians because they are amazing at knowing where all the free events are in your community. Or you can always kind of Google things and just see what's happening in your area and kind of make a list and plan your calendar according to all of those free and fun events that you might find. So just some tips on how to tackle that. So let's talk about credit. In a nutshell, your credit report is really just a record of how you pay your bills. Like it or not, if you pay late, that's 30 days or more is considered late. That mark on your credit report will likely mean the difference between getting a good interest rate or a bad interest rate. So um, some of the things that are on your credit report, as you can see here, so your identifying information, your credit information, any public records information. So this means if anybody's ever sued you, taking you to court, that information will also be on your credit reports. And then obviously anybody that has inquired about your credit report as well. Credit scores. This is really just a snapshot at the moment that that credit is pulled of what debt you have and how likely you are to continue to pay it. It represents your credit worthiness to other creditors. So this slide kind of gives you the range of credit scores and gives you an idea of what is good or bad here. Actually, that has a 0 through 579. Credit scores actually start at 350. So I've never actually seen a credit score that low. I think the lowest credit score that I have ever actually seen in my financial industry experience has been about a 460, I want to say, which was pretty low. So this just kind of gives you an idea of if you know what your credit score is, obviously as we go from the red to the green being the better position there, it just kind of gives you some of the general ideas of why your credit is what it is. I know that most financial institutions, most credit card companies now are offering credit scores. What you also want to know is that not all of them are FICO credit scores. So as you can see on my slide here, this is based on the FICO credit scores. If you are a member with us, you do have the option of looking at your credit score on a daily basis. And like I said, I think most financial institutions, if not your credit card company, are likely offering to allow you to see your credit score, maybe not on a daily basis, but possibly on a monthly basis as well. Really, as long as you're making your payments on time, do you need your credit score on a daily basis? No. As long as you're making your payments on time, that credit score will follow. It will conform to a good credit score. If you're not making your payments on time, if you have collections, if you have late payments, then that credit score will follow as well. And you're likely going to be more in that orangish area. So let's kind of take a look to see how these credit scores are determined. And there's 5 major factors that FICO considers when determining your credit score. The biggest factor is your payment history. So this is how have you paid your debts in the past. So again, late payments are a very big hit to your credit score. And when we're talking late payments, this is 30 days or more late. So typically your financial institutions are going to give you some kind of a grace period to make your payments. So if you have a mortgage, typically your mortgage is due on the 1st of the month. But as long as you make it before the 15th of the month, you won't get hit with a late fee. However, if you make it after the 15th of the month, you will get hit with a late fee. However, it's not going to affect your credit score unless it's more than 30 days late. What it does affect is your relationship with that lender as well. So there's a little red check mark probably next to your name if you're making it, 15, 16, 20 days after the first. Not necessarily that that's going to affect anything majorly, but it may affect that same lender wanting to refinance your loan. But it's not going to affect your credit score unless it's more than 30 days late. The second largest factor is how much you actually owe. So how much debt you actually have. And that's balances on your credit card, balances on, how much do you still owe on your car, how much do you still owe on your student loans, your mortgage. All of that is taken into consideration. It makes up about 30% of your FICO score. And then 15% is how long have you actually had credit for? Most of your lenders are looking for at least 24 months prior. So if you're going to try to get pre-approved for a mortgage, most of your lenders typically want to see at least 24 months worth of history. So if you've only just opened up your first credit card, let's say a year ago, you may not have a strong enough credit score for a creditor to be willing to pre-approve you for a mortgage. That's not to say that if you've had credit in the past or anything like that, and maybe you just paid off your car. So there's different factors, but when we're talking the length of credit history, this is referring to what is the oldest credit line that you have actually had. How long have you had credit for? Have you only had credit for 3 years, or have you had credit for 20 years? That's going to make a difference for your credit score. And then the last 20% is split between what kind of credit do you have? So do you have only revolving credit, which we talked about? Your revolving credit is mainly your credit cards, or do you have installment credit as well? Which means that you've had maybe a car loan before, you've had student loans, you've had a mortgage before. So the credit mix is also important. It's only 10% of your credit score, but nonetheless, it is important, as well as new credit. How much new credit do you have? So if any of you have taken out credit cards recently and you keep tabs on what your credit score is, anytime that you open up a new credit card, your credit score takes a hit. Your credit score typically goes down. And on average, you would probably say it would probably go down about 10% for every new credit line that is open at any given time. So this is really what makes up your FICO credit scores. And again, I alluded to it before, but we're talking FICO scores. Some of your creditors, I know Credit Karma is a popular one out there. If you are keeping tabs on your credit score with Credit Karma, that is likely going to be different than what your FICO score is. And most lenders are using FICO scores to pre-approve you for anything really, whether it's credit cards, car loans, mortgages, student loans, any of that. Most of your creditors are using FICO scores. Credit Karma, I believe, uses Vantage scoring, which is just a different scoring method. I believe that Vantage uses 6 categories instead of 5. So it's just a little bit different scale that we're talking about. So besides credit, what else are creditors or lenders looking at? If you applied for a loan today, they're called the 3 C's of credit. They're looking at your character, your capital, and your capacity. So your character is really your credit history. Lender may decide whether you possess the reliability to repay the debt that you are asking them for with what kind of character you have. And then your capital, this is how much you actually have. This is what your net worth is, how much you actually have in value, personal property, investments, savings, those types of things. And then your capacity, this refers to, are you able to actually repay your debt? So when you're applying for, say, a mortgage, They're going to ask you for 30 days worth of pay stubs and the last 2 years worth of your federal tax returns. And the reason for that is they're looking at how capable are you of making this payment if they were to extend the debt to you. So those are the three factors that creditor is looking at besides just your credit score. So how can you actually improve your credit? Well, we talked about credit scores, right? So some ideas to help improve it. We offer a understanding credit class as well. So if you are interested in that, we talk all about just credit. So keep an eye out for that. We might be invited back to Gail Borden to do a understanding your credit seminar. Otherwise, you can always reach out to us directly, and we'd be more than happy to let you know when we offer one of those. But just some tips here on how you can improve your credit. Catch up on all your payments. Obviously, as you saw, your payment history is the biggest factor that makes up your credit score. So if you are making late payments, catching up on those and making sure that those are all on time will certainly make a difference. Keeping tabs on that credit report if you are trying to improve that credit score. Definitely keeping tabs on it is going to help out. Paying down that debt, again, that's the second biggest factor for your credit score. So paying down as much debt as you possibly can or avoiding incurring more debt is also going to help. And maybe looking into a secured credit card. If you don't have any credit cards currently, and maybe you're trying to establish credit, looking into a secured credit card is definitely going to be one of your best options for establishing credit. Okay. What I will warn you is you can only improve your credit score. You cannot typically correct your credit score. So you can only correct something that was actually an error, a reporting error. So if you made late payments, that can't be corrected. That can only be improved on. So there is a difference between improving your credit score and correcting your credit score. I know that sometimes I'm up late at night and I see commercials for, fix your credit today and, improve we'll fix your credit or we'll straighten your credit out. Um, don't think that if you have made late payments or if you have any collections out there, that there is an actual fix for that. The only fix for that is to get more time away from those late payments. But if your payment was actually late to a creditor, there's no way to fix that. What's done is done. The only thing that you can really do is move forward from there and improve your payment history. So making your payments on time and continuing to make those payments on time, paying down that debt. So you can improve your credit. You can't necessarily correct something that actually happened. If you had late payments, there's no real way to correct those. No creditor is usually going to correct a payment that was in fact late. So, and then establishing good credit. So again, we kind of talked about applying for a secure credit card. This is usually your best bet. Secured credit cards, a lot of financial institutions offer these, and they work very similarly to a debit card. So you set a certain dollar amount in those secure credit cards, and then as you use and make those payments on that credit card, on that secured credit card, the bank will report that to the credit bureaus as well. So putting utilities or rent in your name, this is a form of establishing credit. So as an example, if you had no credit today, if you've never had a credit card, you've never had a card payment, you've never had a student loan, any kind of loan, any kind of credit card, if you had zero credit today, you may still be able to get pre-approved for a mortgage, for example. There is institutions that will take what's called alternative credit as a form of credit. So having no credit really, in some instances, could be better than having bad credit, depending on how bad that credit is. So, but putting utilities in your name, making sure that you're paying those either by check or debit card, making sure that you have some way of tracking that you've been making those payments can be a form of alternative credit. So making sure that your rent is in your name, that you have a lease, that you're paying that rent with a bank check every month, and being able to track that. Many lenders will see that as a form of alternative credit. Local department stores or gas stations are typically going to be easier to obtain those credit cards. So that can be a start to establishing credit. However, you have to be very careful that you're not carrying a balance on those credit cards, because typically your department stores and gas stations are the ones that are going to hit you with the highest interest rate as well. Getting a small personal secured loan. So a lot of financial institutions do offer what's called a secured collateral loan. So if you have, let's say, $500 sitting in your savings account, you can turn around and put that into a CD and loan yourself that $500. So basically, you're lending yourself your own money. The advantage is that you're making installment payments on a monthly basis, and those are reporting to your credit. And it's a very, very cheap way to do an installment loan as well. Most of your financial institutions, I think we charge 3% above whatever interest rate you're gaining on that CD. So 3%, it doesn't get much cheaper than that. And then opening up an account at a credit union or financial institution is always a good idea as well. So just be aware that that is a different type of credit, but again, can possibly be used as alternative credit as well. How do you maintain good credit? Well, you create a spending plan. And a budget or spending plan, I think, was our last session that we did with Gail Borden Library. So creating that spending plan or that budget, living within your income limits, provide complete and accurate information. Make sure that when you're applying for any kind of credit card, any kind of loan, that you're providing complete and accurate information on that. Paying all your bills on time is always key. Having credit, but not too much credit. I used to do mortgages in a past life, and I used to tell people all the time, if you have more than 3 credit cards, you probably have too many credit cards. And I kid you not, most people kind of gasp and go, what? But it's true. If you have more than 3, 4 credit cards, you probably have too many credit cards, and you might want to really kind of look at that and see, do I have the option of closing any of these out? Can I pay them off? But really kind of sitting down and looking at, how long have you had those credit cards for? Because closing out your oldest credit card can also hurt you. So as we saw, the length of how long you've had credit is a pretty good factor as well. So, knowing how much credit you have and that mixture of credit is also very important. Keeping credit card balances low or to nothing, paying those credit cards off on a monthly basis is always the best way to use your credit cards. Calculating and knowing what your debt to income ratio is. So when you're calculating your debt to income ratio, you're calculating your gross income, and then you're calculating that per month and figuring out what your debt payments are. So this is all your credit cards, car loans, student loans, anything that shows up on your credit report is considered debt. So taking those two numbers and then dividing your debt payments by your gross income will give you your debt to income ratio. If your debt to income ratio is more than 36%, it's probably a little too high. So knowing what your debt to income ratio can really help you maintain good credit. And then contacting your lenders if you ever do fall behind on any bills or you think you're going to be late, reaching out to your lenders and just discussing, letting them know, being aware of them being aware of what the situation is. There might be options to, skip a payment, or, they may be willing to work with you in some way, shape, or form. So if you are trying to establish and maintain good credit, really just getting yourself organized in that way can be huge. So I know that these sessions always kind of go really, really quickly for me. I know, I've just kind of gone on and on and on here, but that's really all that I have. I'll kind of get it back to Sadia to see if there's any questions that we can answer. But otherwise, I think we have about 10 minutes or so, 12 minutes, it looks like.
Okay. Thank you so much, Marlon. That was another great presentation. I really appreciate that. I do have a question. It is, would you suggest paying off your low balance credit cards to build momentum or make payments towards your higher credit card debit?
So I think I understand the question, because there is different theories on how to pay off your existing debt. So it really just kind of depends on what is going to be easier for you as an individual. So I believe that the question is, would you suggest paying off the credit cards with the smaller balance first, or the credit cards with the higher interest rate first? So those may be two different credit cards that you have. So you may have a credit card that has a balance of, $500, that it's an interest rate of 10%. And you may have a credit card that has a balance of $1,000 and an interest rate of 20%. So which one do you pay off first? It's really a matter of sitting down and looking at all of your credit cards, and really making a spending plan for yourself, and knowing what can you afford to send additional to what credit card. So I would say, in the example that I just gave, if you sat down and you calculated your gross income, and you have a list of all of your credit cards, and maybe you have 6 or 7 credit cards, and those total, maybe $10,000, that's a lot of credit card debt. You may be better off, once you figure out, okay, I have an extra $100 that I can put towards any of these credit cards. You may be better off sending that extra $100 to that small $500 balance credit card, because what's going to happen is you're going to pay it off in 5 months. And now the payment that you used to have to make to that credit card, maybe it was $75, and you were making $175 for the last 7 months. Now you have that $175 to put towards the next credit card. If the intent is to pay off all of the credit cards, that's what I would suggest doing, is starting with the smaller balance. If the intent is to save as much money monthly as you can, then maybe you send it towards that higher interest rate credit card, because that's the one that's charging you more, and that's the one that's eating away at your income quicker. But it really, again, just kind of depends on each individual situation, and how much you'll be able to send towards, your goal. I hope that answers the question.
Okay, any other questions or comments? All right, I think, Marlon, you answered the questions.
Right, and I think we're about 9 minutes ahead, so you guys can all have 9 minutes of your life back.
Well, thank you everyone for joining us, and please do keep visiting our website for other programs that we will be offering. And Marlon, thank you again, and hope everyone has a great evening.
Thank you, you too. Have a good
Bye-bye.
night. Bye-bye.